I don't own gold because I think it might go from 2,400 to 2,750. That doesn't interest me at all. I own gold because I'm afraid it's going to go to 7,000 or 8,000 or 9,000. And when I say afraid, I really mean that. The circumstance that takes gold to 9,000 US dollars is invariably a very unpleasant circumstance and would devastate other parts of my portfolio. A precious metals bull market is initially led by gold. The first adherents to the narrative, the precious metals narrative, are fear buyers. And so the momentum has to be established by gold. My experience again tells me that once that momentum has been established, perhaps because of the lower unit cost, that silver takes over and begins to move further and faster.
Gold prices are once again flirting with resistance near $2,400 an ounce, and one research firm expects that it's only a matter of time before the precious metal sets fresh all-time highs. In their weekly note published Thursday, analysts at Metals Focus said that the eventual monetary policy easing from the Federal Reserve will drive gold prices higher in the second half of the year. Traditionally, individual investors or retail hoarding drive significant gold price hikes. However, in the past 2 years, except for the last few weeks, retail investors have been net sellers of gold, particularly through physical metal ETFs. Despite this selling trend among retail investors, central banks have been consistently buying gold. This divergence is noteworthy because it suggests different motivations and market dynamics between individual investors and institutional players like central banks. A significant factor shaping recent trends is the increased demand from central banks, particularly in the emerging East and Central Asian markets. According to a recent report from the World Gold Council, these regions have spearheaded net gold purchases in the first quarter. This aligns with the 2023 Central Bank Gold Reserve Survey, which indicates a strategic shift towards greater allocations of gold in national reserves over the next 5 years. The recent shift in retail investor behavior, from selling to buying, could signal the beginning of a broader market movement. Historically, retail buying combined with central bank purchases has the potential to drive substantial price increases in the gold market. For long-term investors like Rick, owning gold is not about short-term gains. Instead, gold is a crucial insurance policy against potential extreme economic scenarios that could drive its price to $7,000, $8,000, or even $9,000. Such a significant increase in gold prices would likely be accompanied by challenging economic conditions that could devastate other parts of an investment portfolio. Therefore, owning gold safeguards against these potential adverse circumstances, ensuring some level of financial security in uncertain times. We will present clips from Rick Rule's interview with Soar Financially. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
People who have owned gold for 2 decades, like myself, will note that gold has done its job. And I think the fact that it has done its job in US dollars and more than done its job in foreign currencies over the last 20 years has done as much as anything else to increase activity in gold. Now, the very recent move in gold is unusual in the sense that normally gold price escalation is a consequence of individual investors or retail hoarding. The last 2 years, with the exception of the last 7 weeks, have been marked by retail dishoarding. If you look at the statistics around the ETFs, physical metal ETFs, you will see that for 2 years, retail investors have been selling gold, while at the same time, the central banks have been buying. Whether or not the last 7 or 9 weeks, depending on how you count, whether or not there has been a sea change in retail sentiment is a different question. But I would suggest to you, Kai, that gold and silver are probably just getting started as opposed to how to their moving. My suggestion is that while the retail investors have changed from sellers to net buyers, the net buyers relative to historic norms in gold bull markets are still extremely muted. And the incentives around central bank gold buying, which is to say the poor arithmetic around U.S. Treasury securities and the weaponization of the U.S. dollar, both through the confiscation of Russian assets in U.S. dollars and also the attempts of the U.S. government to apply hegemony on the SWIFT banking system means that central bank buying continues. If you see retail buying overlaid on top of central bank buying, then I think you see a real move in the gold market. If you went like I did through the decade of the 70s, where the gold price would move, as an example, from $120 to $170 in fairly short order, the move that we saw in percentage terms was not particularly violent. Violent in the context of gold price moves since maybe 1982. But in a historical context, I would suggest not very violent at all. Now, I need to admit that I've experienced enough volatility in my life that I'm surprised by the lack of volatility across all markets. For the life of me, I don't understand why the VIX is so tame. But I guess even an old man learns new tricks. I need to say too, Kai, that it's ironic, given that I'm so much older than you, that I have more patience. I have much less time on Earth. And it's not like I don't want to be rewarded quickly. It's just that I've learned that rewards take longer to accrue, much longer to accrue. I think I said on your show in January, I don't own gold because I think it might go from 2,400 to 2,750. That doesn't interest me at all. I own gold because I'm afraid it's going to go to 7,000 or 8,000 or 9,000. And when I say afraid, I really mean that. The circumstance that takes gold to 9,000 US dollars is invariably a very unpleasant circumstance and would devastate other parts of my portfolio and usher in, I think, a much more challenging lifestyle. At my age, I don't want a challenging lifestyle. However, the set of circumstances that surrounds me suggests to me that I need to own gold as an insurance policy against the set of circumstances that would take gold not marginally higher, not to some psychologically important $2,700 number, but some substantially materially important move like $7,000 or $8,000 or $9,000.
Silver prices have continued their upward trend, trading around $30.39 and reaching an intraday high of $30.61. This surge is largely due to a weaker US dollar amidst growing expectations of Federal Reserve rate cuts. Rick notes that gold typically leads in a precious metals bull market, driven by fear of buyers adhering to the gold narrative. Once gold gains momentum, silver often follows, accelerating further and faster due to its lower unit cost. Another factor contributing to silver's price dynamics is the limited market capitalization of genuine silver stocks. So when generalist investors, those not specialized in precious metals, pour money into silver, it can lead to dramatic price movements. Some of the higher quality silver junior stocks, smaller companies focused on silver mining, have recently shown interesting gains. These gains indicate growing investor interest and confidence in the potential of silver. Despite these positive developments, the overall price action in silver remains puzzling. The metal has fluctuated around the $30 mark, a level many analysts and investors view as a critical support line. This fluctuation suggests that while there is strong upward momentum, significant market forces are also at play that are causing silver's price to consolidate around this key level.
My experience has been that a precious metals bull market is initially led by gold. The first adherents to the narrative, the precious metals narrative, are fear buyers. And so the momentum has to be established by gold. My experience again tells me that once that momentum has been established, perhaps because of the lower unit cost, that silver takes over and begins to move further and faster. Are we far enough along in a gold bull market that silver catches fire? In our last interview, I said it would probably take a year or 18 months. That took place in January. Maybe all things are moving faster now. I don't know. And I don't know why silver outpaces gold, frankly. I've thought an awful lot about that. But I do know, looking at past major markets and small rebound markets, that gold leads the market and then silver takes over leadership. And when silver takes over leadership, it moves further and faster. I know, too, that the combined market cap of the real silver stocks, I don't mean the people that have silver as a component on the name of the company in the share certificate, but rather companies that have some silver. That's the most volatile sector of all. The combined market capitalizations, the silo, if you will, of silver juniors is so constrained that, as Doug Casey puts it, it's like siphoning Hoover Dam through a garden hose. And we began to see some pretty interesting moves in the higher quality silver juniors in the last 3 months. Is this break up, if you will, break out in silver real? I don't know. I absolutely don't know. I don't particularly care what happens week to week. I really don't. I don't watch the silver price week to week. I just don't. And I'm not interested in trading or psychological support at $30. I own silver because, in my experience, when gold moves, really moves, silver really, really moves. A larger part of my portfolio is denominated in gold, because I'm older. I own it as an insurance asset. But I have been in 4 different markets where silver materially outperformed gold. So I do have a speculative position, more heavily geared to the silver stocks than to silver. I own it not because I think that there's a high probability of profit. I own it because I think there's a possibility of truly extraordinary profit. It wouldn't surprise me that a 2.5% or 3% portfolio position, which is the approximate size of my allocation to junior silver stocks, could, in the 3 to 5 year time frame, constitute 25 to 30% of my overall portfolio. That's why I do that. I'm not saying it's a probability. I'm not saying it's going to occur. I'm saying that, based on my past experiences, that there is enough of a possibility of a tenfold increase in a portfolio of high quality silver stocks. And because I can afford the risk, both financially and psychologically, I'm in that place. When I have this discussion with some younger people, what I find out is that they bought the silver narrative so completely that they have 50% of their portfolio in junior silver stocks. And I think that's an insanity, a true insanity. Maybe not if they're officers and directors of small silver mining companies. In other words, if they're investing in themselves. But passive investors, particularly young passive investors, who need fairly balanced portfolios, who need compounding and time on their side, shouldn't overallocate to any speculative asset.
If gold reaches $9,000 per ounce, it likely signals severe economic instability or geopolitical turmoil, driving up silver and other precious metal prices as investors seek safe haven assets. This surge would attract retail and institutional investors, including central banks, leading to further demand and price increases. Share your thoughts on Rick's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.